Well, as usual, we are starting things by taking a look at the market and, of course, incoming economic activity that drives sentiment on Wall Street. Joining me now with more on this Friday is Daniel Lacalle. He's a chief economist at Tressis. Daniel, it's great to have you on the show. And amid a lot of economic data this week, including those inflation reports, what is your read on the health of the economy?
The U.S. economy is clearly much stronger than the developed economies in general. We have seen very, very poor figures coming from the UK, Germany, France, etc. So the United States economy is expected to grow this year between 2.5 to 2.7%. It could actually grow faster if the measures that have been announced are implemented in the first 100 days of the presidency. And in general terms, what we believe is that there's going to be quite a strong outlook guidance in terms of the earnings season. That's what investors need to be paying a lot of attention to, the differences between companies and the outlook that they're giving in terms of margins and of sales growth. But it looks like a very robust earnings season that shows that the United States economy is doing much better than its peers.
What does that mean for equity markets, Daniel? The strength that we see in the economy and anticipate to show up in earnings these next few weeks?
One of the things that one tends to hear quite regularly in markets is this idea that emerging market equities or European equities are cheaper than US equities. However, when you look at each of those sectors individually and you compare the level of growth and the level of margin growth of the companies, what it is actually showing is that US equities are a lot more attractive than most of those allegedly cheaper or value-oriented stocks. So I think that what that means basically is that we will continue to see a strong move of capital out of emerging economies and into US equities as that evidence of improvement in margins. And obviously, rationale behind the multiples. The companies are relatively more expensive because they deserve so. So I think that is a good environment for U.S. equities, both the strength of the U.S. economy and the strength of the U.S. dollar.
The market is closed on Monday to honor Martin Luther King Jr. Day. That same day, on January 20th, we will see President-elect Donald Trump inaugurated, and perhaps we could see some executive orders initiated in the first 24 to 48 hours. Knowing that is on tap on Monday, how does this new administration change the investment landscape for folks out there?
I think that in general, everybody's expecting huge pro-growth policies, basically aimed at strengthening the private sector, strengthening small and medium enterprises, which is likely to help the Russell 2000 quite significantly, tax cuts, improvements in regulation that unlock quite a bit of investment, and a few significant executive orders in terms of energy that will likely drive the energy sector to higher multiples than the European or emerging market peers.
We had an energy IPO yesterday, the biggest IPO so far in 2025. A few weeks in, Flowco going public, an energy equipment provider based out of Texas. Positive reception, priced above the range, closed at more than 20% in its first day of trade. And Venture Global, also in the energy space, specifically with LNG, is going to debut, we expect, next week. What does that say about an opening up of capital for companies like energy?
Very significant. One of the huge problems in the past years in the energy sector has been underinvestment. So the enormous potential of new investment coming, you've just mentioned LNG. There is an enormous pipeline of projects in the LNG market coming on stream in the next 4 years. But also the possibility of the United States going from the current record levels of production 14 million barrels a day to 18. That is going to require a lot of investment, a lot of equipment, a lot of engineering capacity. And that is certainly something that is positive, with the energy sector going from underinvestment to investing back at the levels at which it used to 7, 8 years ago.
How do rates factor into this? We'll get a decision from the Federal Reserve in just about 10 days' time. Traders, by and large, expect the Federal Reserve to keep interest rates where they are at this meeting, likely in March as well.
I don't think that there's much of a need for big rate cuts for the energy sector to attract investment and to generate that level of capital expenditure that is required to grow, as we mentioned, because the energy sector is very cash efficient and very cash rich. And at the same time, the cost of capital has come down quite significantly, and the cost of production and the cost of development has also been quite significantly reduced. So I think that rate cuts are important, but what's really important is to see that banks all over the world are starting to be a little bit more rational about providing financing for energy projects, because the world is understanding that you need to invest in order to achieve not just the energy transition, but energy independence, which is a very important factor for the United States.
Daniel Lacalle, Chief Economist at Tressis. Daniel, always great to have you on the show. Thanks again.
Thank you. Great pleasure. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.